Charlie Munger, often known as Warren Buffett's right-hand man, but in his own right, he is a very smart investor. He achieved a 19.8% return with his investment partnership. But the interesting thing is, he achieved this market-beating return through following 5 very simple investing rules. I'm going to let Munger show you them.
How worried are you by the declines in the share price of Berkshire Hathaway, the difficulties the
Zero.
company's in?
This
No?
is the third time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets that the long-term holder has his quoted value of his stock go down and then by, say, 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder and you deserve the mediocre result you're going to get. Wall Street attracts and rewards what I call a locker room culture. There are a lot of people who just have to win at football or soccer or something like that. And they're just so competitive that whatever A is doing, they have to be as good or better than A. And of course, Warren and I don't have those compulsions. And I would rather live my way than theirs. They do enormous damage to the rest of us with their damn locker room culture that has to win. And is not very squeamish about what they have to do to win. We have to deal in things that we're capable of understanding. And then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas. And the reason that our ideas have not spread faster is they're too simple. The professional classes can't justify their existence if that's all they have to say. I mean, it's all so obvious and so simple. What would they have to do with the rest of the semester?
So for 50 years, you've continually read about these industries even though you have disdain for them.
Yes, I talked about patience. I read Barron's for 50 years. In 50 years, I found one investment opportunity in Barron's, out of which I made about $80 million with almost no risk. I took the $80 million and gave it to Lilo, who turned it into $400 or $500 million. So I have made $400 or $500 million out of reading Barron's for 50 years and following one idea. Now that doesn't help you very much, does it? I'm sorry, but that's the way it really happened. If you can't do it, I didn't have a lot of ideas. I didn't find them that easily, but I did pounce on one.
Which one was that? Which idea was that?
It was a little automotive supply company. Anyway, it was a cigar butt.
Is that KNW?
No. This was, I've forgotten the name of it, but it was the Monroe shock absorber and all that stuff. The stock was $1, and the junk bonds was paid 11 3/8%, were 35. And when I bought the junk bonds, they paid me the 35%, and they went right to 107 when they called. You know, it was. And then the stock went from 1 to 40, but of course I sold my stock at 15. But
so what did the article in Barron's say?
Yeah, what was it?
It said it was a cheap stock.
Hold
The only one, right? Only article
But
that
that's a
said that.
very funny way to watch for 50 years and act once.
How long did it take you to make the 15 bagger on that?
What?
How long did it take to make the 15x on that stock? It went from 1 to 15, right?
Maybe a couple of years.
How long did it take you to make the decision to buy it once you read the article?
Oh, about an hour and a half.
What was it about that company, an auto supply company, that was
Well,
a bad
I kind of knew, based on experience, how sticky some of that auto secondary market was, and how many old cars needed Monroe shock absorbers, and I just knew it was too cheap. I didn't know it would work for sure, but I knew that I just, as I say, people were afraid it was going to go broke, obviously, if their bonds were selling at 35. Am I comfortable with a non-diversified portfolio? Of course I'm. Well, if you take the Mungers, I care about the Mungers. The Mungers have 3 stocks. We got a block of Berkshire, we got a block of Costco, we have a block of Lilu's fund, and the rest is dribs and drabs. So am I comfortable? Am I securely rich? You're damn right I am. And could other people be just as comfortable as I am if they didn't have a vast portfolio with a lot of names in it, many of whom neither they nor their understand or their advisors understand? Of course they'd be better off if they did what I did. But and is 3 stocks enough? What are the chances that Costco is going to fail? What are the chances that Berkshire Hathaway is going to fail? What are the chances that Lilu's portfolio in China is going to fail? The chances of any one of those things happening are almost 0. And the chance that all 3 of them are going to fail. Of course it's going to. That's one of the good ideas I had when I was young. When I started investing my little piddly savings as a lawyer, I tried to figure out how much diversification I would need if I had a 10% advantage every year over stocks generally. I just worked it out. I didn't have any formula, I just worked it out with my high school algebra. And I realized that if I was going to be there for 30 or 40 years, I'd be about 99% sure to do just fine if I never owned more than 3 stocks, and if my average holding period was 3 or 4 years. And once I'd done that with my little pencil, I never a moment believed this balderdash they teach about wide diversification. And if you're diversification is a rule who don't know anything. Warren calls them know-nothing investors. If you're a know-nothing investor, of course you should own the average. But if you're not if you're actually capable of figuring out something that'll work better, you're just hurting yourselves for looking for 50 when 3 will suffice. Hell, 1 will suffice if you do it right. 1. If you have 1 cinch, what else do you need in life? And so the whole idea of that the know-something investor needs a lot of diversification. To think that we're paying these professors to teach this crap to our young. And that people think they should be paid by telling us to diversify. Where it's right, it's an idiot decision. And where it's wrong, you shouldn't be teaching what's wrong. So it's what's going on in corporate finance teaching is that people are getting paid for dispensing balderdash. And since I never believed it was a great help to me. It helps if you're out in the market and the other people are believing balderdash and you know what the hell's going on. It's a big help. But so, of course you don't want a lot. If your Uncle Horace, who has no children, has an immense business which is immensely secure and powerful, and he's going to leave it all to you if you come to work in the business, you don't need any diversification. You don't need any corporate finance professors. You should go to work for Uncle Horace. It's a cinch. You only need 1 cinch. And sometimes the market gives you the equivalent of an Uncle Horace. And when it does, step up to the pie cart with a big pan. Pie carts like that don't come very often. When they do, you have to have the gumption and the determination to seize the opportunity shrewdly. I was lucky. Imagine learning that from your dead great-grandfather.
And you know, these are very basic rules or ideas that Charlie Munger follows. It's not like you have to be Einstein to apply these rules to your own investments. But that's the funny thing, it's almost like these rules are too simple and people feel like they have to complicate things. But that's why they lose to the market and Charlie Munger beats the market.